a lot of feelings what price of oil will go. If you're looking at it from a fundamental standpoint, will oil race up to $100 like they've talked about, or is it a situation where the economy is weak? The issues and the problems that they're having with the euro and the European economy, is that going to weaken the world economy, weaken the demand for oil? A lot of fundamental factors there. Well, none of those do I know the answer to. None of those can I have any bearing on. None of those can I solve the problems that are there. I can't even solve the problems of getting the oil out of the Gulf. I see ideas, but that's beyond me. So nothing I can do about that, but I can do something about taking a look at the charts and seeing what I'm going to be, how I'm going to be positioning myself. This particular day, we got here to April the 7th. The predicted low on April 7th was 86.04. So that means that now we have to assume that the things have kind of changed. As you can see down below, the predicted differences have turned down. We have the Neuro Index has gone to 0. So there are some bearish things that are coming together. I already mentioned we had a situation with the doji top. A number of situations that would come together that would suggest that maybe we need to look to the downside for our next move. So when we look at that, we see that the predicted low here, 86.04, so we're going to sell at 85.04. That would put us in the market with a short position, and as I say, if it's possible, with 2 mini instead of just one big contract, somewhere in that vicinity right here at 85.04. Again, I have a big thick line there, which isn't probably precise, but that kind of shows you, the possibility. Now, the stop then, if you have, you're going to allow $1.50 per barrel for your stop because that's a maximum risk you want to take. It probably, it's going to depend a little bit on you. It's not going to be this natural stop that you might want to place above the high. But again, you have a risk limit that you're willing to take, and so you're going to have to put your stop at a place where if the worst happens, the market does revert up, you're not going to get hurt. So you potentially, in this particular case, you're in the market at 85.04. If you had a profit target, again, you're probably not going to have a profit target of $1 or $2 or whatever it is. You want to have it somewhat more than that. So in this particular case, the market may have rebounded, probably would have rebounded with the loss in this vicinity right here on the April 15th candle that shot above that predicted high. Probably would have stopped you out. You probably would have been in one of those occasions where you would have had a small loss. It would be, not a big loss because you're keeping your stops within range of that predicted high. The predicted high has moved down since your entry point. So your stop is going to be relatively small. In the cases of the following days, there are some trades in here that, the market was kind of edging lower, and you might have tried to keep after that short contract, that short position, but you can see the market gyrated up and down enough that it would have caused you some concern. You would have taken a few small losses along the way, and some of those $1,500 losses that we talked about as the maximum you're willing to accept. Now we're going to look a little bit about what goes on when the market does get to the point where it really, starts to turn down, and what are our objectives. Again, we're looking at this a little bit in hindsight, so we have a little advantage here of seeing, kind of here's what we do and how we would do it. But this kind of shows you the theory of how you can act when you see that. Again, as we did before, you can see that we have the predicted differences are going down. We have the Neuro Index. Whoops, let's go to that particular line there. This one. And you have the predicted difference right here at 0. So we had some bearish things going on. We had the predicted moving average had turned down in this particular case right here on this candle. So you might say, okay, after this candle and after seeing what is going on here, that we would be able to place a stop $1 below the predicted low. The predicted low on this particular candle was 85.13. 85.13, and so that means that 84.13 is a position at which we would get short, and we would have a stop the $1.50 above or at 85.63. Now again, we'd like it to be above the previous high, but we can't always get what we want. We have to do what we need to do within our risk. in this particular case, if you do have too many contracts, or I mean, you could do this with a full-size contract if you're, willing to accept. You're in here at, as I said, about 84, somewhere right in there, and you potentially could have a situation where you could have a profit target set up to take a profit. Maybe it's $4. It's a little bit up to you. You could take a profit at 80. In this case, if you were in a position where you could trade the full-size contract, you $4 decline, you'd have $4,000. Helps make up for some of those $1,500 losses that you had before. And then you have that other contract that you can then ride down just kind of to see what happens, keeping your stop above the predicted next day high, and then get out if that market does turn around and move back up. Now, assuming that you were able then to stay in there, now you got to watch your next breakout type of a situation that could occur. We see that we have the predicted differences have started to, they've begun to move up. So that suggests maybe there's some underlying momentum as the market has reached the bottom. Maybe that, that weakening influence is kind of, wore itself out, and we're now ready to move to the upside. So on May 26th, we had a situation where the bar, or the candle rather, moved above the predicted high. May 26th, the predicted high was 69.39, and we had a situation where we could buy at 70.39. So now we, want to know, this is, I should really point out that this is a situation where we would have been out at 70.39 from this long position that we had, where we were following this whole market down with that remaining contract. So this is the point at which we would get out. Then, as I mentioned before, I'd like to keep my stops on my new position in two different time frames, just simply because it tends to be a little bit confusing. So if we are following through with what we're talking about before, we have a situation a couple of days ago on June the 4th where we had a predicted low at 73.03. So we're going to be selling, or would have sold, at 72.03. That 72.03 comes in somewhere right in there. And I'm probably a little bit low on that particular mark, but 72.03, and you would be short at that stage. You would have then, using that 150 guideline as your risk limit, a stop at 73.53 here, and of course you're above the predicted high, and as that predicted high moves lower, you can adjust that stop accordingly. So that's where you would be at today's market, at today's price. If the market went above 73.53, you would be out. But at this point, it still looks like you would be in a short position. And keeping in mind that when you're looking at the market where it is currently, where we had these previous lows that came in here about 65 vicinity, and you go back on the chart historically, we are now approaching a point where it's fairly low. Will we get that kind of a breakout? Or will we get the bounce off the breakout? Will the support hold? So the breakout is important.